Good afternoon, everyone, and welcome. My name is Kurt Lalomia, and I'm a financial advisor at Turning Point Financial. Thank you for signing up for today's masterclass on our secrets to financial success for 2024. We're really excited about today's presentation. We believe everyone will come away with some new ideas. What you're about to hear represents the best and brightest thinking from our team and is the collective wisdom of over 100 years' experience. Again, I'm Kurt from Turning Point. You can learn a little bit more about me on this slide. I have over 30 years experience in financial services. I started my career back in the 1980s on Wall Street. I'm a fiduciary, and I take that designation seriously because a large part of my career was spent in legal and compliance departments. I used to supervise advisors, and I've seen good and bad things happen in families' financial lives. I'm on the advising side of the business to make a difference, to provide financial literacy, advice, and clarity. My firm, Turning Point Financial, is a fully registered investment advisory firm. We're regulated by the SEC. Our home office is located in Frederick, Maryland, and we specialize with federal employees. Our clients are from most federal agencies and are located nationwide. You don't have to be in the DC metro area to work with us. We use technology very well to communicate and service our clients across the entire country. Again, we're fiduciaries. That means we're required by law to put our clients' best interests first. We get asked that a lot, and it's important. If you're looking for an advisor, this is a good question to ask because not every advisor out there is a fiduciary and held to that standard. Our website, tpfinancial.com, it's not on this slide, but it will be on a later one. Here's what's going to happen over the next 30 minutes or so, and I like to be upfront so there's no surprises. At a high level, you see the 5 strategies. We'll get into those. They're going to set your family up for success this year and beyond. If you have questions, we're going to take those at the end. You can put those in the Q&A field. There is an opportunity to meet with me if that's something you're interested in. Your participation today entitles you to a free consultation. I'll tell you how that works a little later. What we're doing here today is educational. This is not a sales pitch. And by the way, these slides, they're available upon request, and we also have a recording. So let's get into it. Here's our 5 secrets. They're in no particular order. Some may be obvious, some not. It's an election year, and that will have an impact on your investments. We have 2 slides focused on our election year. Election years usually produce positive returns in the stock market by an average of 8 or 9%. 18 of the last 19 election years have produced positive investment returns in the stock market. You will have volatility, and things are going to be messy. So buckle up and get your head straight. By this, I mean, do not panic. Do not make emotional decisions based on what you're hearing in the news or who you think the president will be. Ignore the noise is what I'm telling my clients. There will be opportunities, but that doesn't mean you should try and time the market. Our advice is to stay the course with your periodic payroll contributions to your TSP. And if your spouse or partner has a 401k or a 403b, they should be doing the same. Some of you also contribute regularly to IRAs and other investment accounts. Continue to be disciplined with those contributions through the volatility and the ugliness of political theater. This strategy of dollar cost averaging will reward you over the long term because you're taking advantage of highs and lows during these times of deep uncertainty. Having someone to talk to, get advice from, that's healthy too. Don't go it alone, especially if you're not working with an advisor. Talk with your spouse, a partner, a friend, a neighbor, someone you trust before taking any action. This will help you avoid the big mistake. And if you like, we're available to help you navigate the uncertainty of this year. I'll have my contact info up again on a later slide. What you're looking at here is a 90-year historical graph of the stock market through various election years. And you can see it's up and to the right. If you want to know more about this slide is from the American Funds. You can go to their website and learn more. Folks, it doesn't matter who wins the White House this year or in future years. I hope this makes sense and provides a little comfort. As I said, it's going to be a messy year, and it just started. Next, we move on to retirement accounts. 3 questions to ponder and our 3 fundamental portfolio practices. We touched on number 1, related to the election, and that's just one of the hot topics out there. How about interest rates, oil prices, Ukraine, Taiwan, inflation? All this impacts our opinion on the future. Second, we also covered that in the election topic. I counseled patience and discipline. Third, managing our emotions. It's hard. And this is where working with someone or having that trusted friend, family member, whatever, can keep you from making the big mistake. You can overcome all of these by being engaged in our 3 fundamental portfolio practices. These apply to whatever types of accounts you have, TSP, 401k, IRA. These are not difficult, and they can often be implemented with your setup. The L funds in your TSP or target date funds in a 401k or 403b, they do all these things for you. The rebalancing is automatic every quarter. Diversification is part of the strategy. And the asset allocation is based on your retirement time horizon and your goals. There's obviously more to it, and this is not a recommendation of these types of funds. Let me know if you'd like to dive deeper into this one. We do that offline, one-on-one. 2023 was a good year for most investors because most people realized a positive return. 2022 was not a good year, and nearly everyone I know lost money. The key is a long-term investment time horizon. Our advice is to not get caught up in what other people are doing, and don't look at your stuff too often. Unless you're involved in a sophisticated trading strategy, I would recommend looking over your investments quarterly at most. Repositioning or rebalancing should be on autopilot, and that's done for you if you're in the L funds. If not, then have your own strategy and implement it during the annual review. If you have investments over and above your TSP, you want those to complement what's going on in the TSP. We don't want overlap, which impacts our diversification, and our next slide speaks to that topic. Lastly, retirement, that's unique to everyone, and there's no magic number. That's something you might consider for your financial plan, which we also get into later. To sum up this slide and to answer the question at the top, the answer is yes. Diversification is having the right amount among your investments, which lowers risk, lowers volatility in your portfolio. It keeps you on track. That's diversification. The 5 TSP funds, they're very large, meaning you own thousands of different companies within each fund. That makes each of these well diversified. The funds you choose, assuming you're not in an L fund, determines another level of diversification known as asset allocation. We have a dedicated slide on that topic coming up as well. Having too much in one fund, maybe under diversification, owning too many funds, particularly multiple L funds, that's definitely over diversification, and that's holding you back It's holding you back from earning more, holding you back from properly managing risk. Roth is one way to incorporate a strategy to manage the uncertainty of what future taxes might look like. Everyone here today should have some of their retirement invested in its Roth option. If not, you might consider a Roth IRA, and everyone can participate regardless of your income. If you believe or you've been told you make too much to have a Roth IRA, you're misinformed. A little used strategy called a backdoor Roth allows high wage earners to have Roth IRAs. Some people do both, TSP and IRA, and you can. Again, with the Roth, you not only get the tax bill out of the way now, but we also pay tax on the smaller contribution amount, not the much larger amount that the account grows to become. A Roth is funded with money that's already taxed. It grows completely tax-free. It comes out tax-free. When you need money in the future, you can use the Roth without having to pay extra taxes. Think about it. If the tax rate's higher in the future, and most people believe it has to be, you'll be in a great position if you have access to tax-free money. That's the Roth. Anyone who has a traditional TSP, traditional 401k, traditional 403b, you need a tax solution. And taking advantage of today's tax rates on sale is the way to be thinking about Roths. That's because at the end of next year, we will revert to the old tax code, higher taxes. So everyone has a little time to execute their own Roth strategy while rates are low. I want to quickly cover the new contribution limits for 2024, and you all should be aware of these numbers. With the TSP, if you're under age 50, maximum contribution is $23,000. If you're 50 and older, you can put in an additional $7,500. IRAs, under age 50, contribution limit is $7,000, $8,000 if you're 50 and older. We all should be maxing out or striving to over time. We have more to say on the Roth in our upcoming tax slides. Estate planning and beneficiary reviews is up next. Your beneficiary, that's who gets your stuff when you get to the end of the line. These next few slides, they may be the most important in the entire presentation. In the course of our everyday business, we review our clients' beneficiaries at least once a year, and you should too. That's whether you work with another advisor or you're doing your own thing. Beneficiaries are associated with your TSP, your IRA, your life insurance. Some of you may have TOD accounts. TOD is transfer on death. Beneficiaries need to be up to date and accurate at all times. And you want people. You don't want your estate, your will, a trust. That's most of the time. There are some unique circumstances where that might be appropriate, but almost all of the time you want people. Anything other than people slows down the process. And changing beneficiaries is easy. Now it's online in many places. Every type of account I mentioned, it has a beneficiary. You need to know who that is. If you can't find it or figure it out, get someone to help you. I can help you. Beneficiaries are different and separate from your will, and each operates independent and separate of one another. You can leave everything to your spouse or partner in your will, but that does not include your beneficiary accounts. Let me explain. Someone we worked with had this situation. The will said to leave everything to the spouse. The IRA beneficiaries were siblings. Guess what? The bulk of the assets were in the IRA, and this created a problem for the spouse. I bring this up because coordination is important. Your estate attorney and your financial advisor, they need to be working together on your behalf to distribute the assets the way you want. If you don't have beneficiaries assigned and something happens to you, a judge will be making the decisions. That's not what you want, and certainly not what your loved ones need. It can take a long time and it can be costly. Let me know if you need help to better understand what I'm saying. Our next 3 slides are just a continuation on this theme of the importance of having accurate beneficiaries and having basic estate planning documents. That's a will, a power of attorney, and a healthcare directive. I've been asked many times about an online or do-it-yourself estate plan. Our advice is don't. There's too much to know, too much to understand, and it's simply best left to an estate attorney. For example, we've worked with people in situations where they did their own will, and it looked great. It made sense. Their intentions were clear, but there were problems because they were not printed, signed, witnessed, notarized. All that matters, and it sounds like a minor detail, but it can make the difference between a will being valid or not valid. We're not estate attorneys at Turning Point, but we can recommend someone for your area. Also, consider asking your friends, your family, your neighbors for recommendations. In the long run, it's worth it to spend the money and get it done right. If you don't, it will likely still cost the beneficiaries. Those costs to your beneficiaries are going to be financial, they're going to be emotional, and they're going to be mental. I'm not an estate planning attorney, but I know enough to be dangerous. I can confidently say that everyone needs some sort of estate plan, regardless of your age, your marital status, stage of career, whatever. Without it, your loved ones inherit a tangled mess. 3 of the 4 things listed on this slide, that's something we all need. Trusts are a maybe. The estate attorney can advise you on that, but most people don't need a trust. Keeping your estate plan up to date is just as important as keeping your beneficiaries up to date. Bad things will happen if you don't, and you don't want to do that to your loved ones. Reviewing your estate plan, it should be done every few years, 5 or 10 years maybe. I had mine updated recently after 20 years. The laws in Maryland, where I live, they had changed, so it was necessary. My adult kids, they were involved in the process, so it was a nice learning experience for them. We're going to move along. Taxes are up next. What can we do to lower the family tax bill? Well, it's the Roth. Roth IRA, Roth TSP, Roth 401k, 403b, Roth conversions. I'm going to repeat myself and reaffirm what I previously stated. Everyone here today should be making contributions to your Roth. That's a Roth IRA or a Roth TSP. Roths are funded with after-tax dollars. They grow tax-free and the money comes out tax-free. That's tax-free income, and it can have a major impact during your retirement years. Tax-free income can lower the Medicare premiums, lower the taxes you pay on your Social Security benefits, and Roths can reduce or eliminate required minimum distributions, the RMDs. Let's move on to Roth conversions. That's something I do every year as part of my long-term tax strategy. I do it because it allows me to lock in today's low tax rates. Having a Roth removes the uncertainty of future tax rates. The Roth conversion, that's simply converting or moving money from a traditional IRA to a Roth IRA and paying taxes on the amount converted. Those taxes are paid when you file. Best of all, distributions from the Roth, they're invisible on your tax return. That means that money you take out is not reported to the IRS. If you or your spouse or partner, if you have old retirement plans, maybe it's a 401k from an old job, a 403b, even an IRA, you can use those accounts to jumpstart the Roth. Just to repeat, it involves paying taxes now in exchange for not having to pay tax on distributions later, like during retirement. What do you estimate the future tax on your RMDs if you don't convert? What does that mean? Well, if you don't convert, you're in the land of RMDs, which is taking out what the government tells you to take out and paying taxes on those amounts at whatever the tax rate is at that time. And this is whether you need the money or not. I said I convert a small amount every year because the tax bill on converting the entire thing, it's too much. This is my plan. I want my plan, not the government plan, which is RMDs. RMDs start at age 73 for any traditional retirement plan. That's IRAs, 401ks, 403bs, and a TSP. We call this the government plan because it forces you to take a certain amount out each year. This is how taxes are collected. Those RMDs are taxed. Roths never have RMDs because you paid the tax up front. I love the Roth. You can probably tell. Personally, I have a Roth IRA, as does my wife. We make Roth contributions to these and our work plans. Next, I want to get into different types of accounts offering different strategies. What we're touching on here is trying to come up with a tax-efficient withdrawal strategy. If you have options to take money from accounts that offer different tax rates, you are truly in your own plan and not the government plan, and that's where we all should strive to be. The types of accounts that are referred to are the Roth and traditional IRAs, non-retirement investment accounts, TSP, 529, HSA, FSA, bank accounts. The idea is to pull funds from the right accounts to pay the least amount of taxes. You will pay more taxes without a long-term tax strategy. Perhaps not this year or next, but it's likely it will cost you a lot more in the long run. What the heck am I talking about? There are little things you can do today, this year and beyond, to lower your long-term tax bill. Participating in the Roth is just one example. I'll show you some ways, I'll share some stories. Taxes are expected to be higher in the future, and the Roth will help you manage that. Long-term tax planning involves understanding all of your sources of income during your retirement phase. Those sources of income are numerous. It's a pension, it's Social Security, it's RMDs, it's Roth. You may be working part-time, you may have investment income, there may be rental income. And then what does your spouse or partner have going on? That's a lot. The understanding that I'm talking about are the tax consequences, and not only how all that fits into different tax brackets, but how it impacts your Medicare premiums. And those Medicare premiums, they range between $160 to $560 a month. It depends on your income. The higher your income, the higher the premium. If you plan well and you have a solid source of tax-free income, then you're going to have lower Medicare premiums. See, the tax-free income doesn't impact what you pay for Medicare or how much your Social Security will be taxed. I hope this is sinking in and making some sense because most people don't understand this aspect of tax planning. Center of the slide here, we have three buckets of money. We call taxable, tax deferred, and tax-free. Everyone's goal should be to get as much as they can into that tax-free bucket. You should look over your stuff, see what that looks like. Let me give you some examples of each of the three categories. The taxable accounts, that's what you have in the bank. That's what you have in a brokerage account. You pay tax on the interest, on the capital gains that are earned in those types of accounts. Tax deferred, that's your traditional TSP, traditional IRA, traditional 401k. Pay tax later on when you take the money out. And then the tax-free bucket, that's what we're talking about here, what I'm pounding the table on. The tax-free bucket is the Roth. Some of you have heard me say it before. It's okay to pay our fair share of taxes, but no one wants to leave the IRS a tip. And if you're not proactive with tax planning, it's likely you're leaving the IRS a tip. I want to quickly cover some tax-related recommendations that we commonly use with the families we work with. You want to max out or strive to in your TSP, your IRA, your HSA, 529, FSA. Strive to max all those out or some of those out because all of these will lower your taxable income. Want to grow the tax-free buckets? Look over your taxable accounts for tax-efficient investments. One of the ways we help our clients is with the use of ETFs. That's exchange-traded funds rather than mutual funds. Folks get burned every year with capital gain distributions. Mutual funds have that big surprise at the end of every year, and you pay tax on those distributions. Tax loss harvesting, that's something your advisor should be talking to you about if you're working with an advisor. And if they're not, then we should probably have a conversation. Roth conversions, quick, efficient way to grow your tax-free bucket. Tax planning integrated with your financial plan. That's essential to lowering the massive long-term tax bill we've been talking about. The question you need to address is, are your tax advisor and your financial advisor, are they talking and working together to lower your taxes and keep them low? Lastly, another one of my sayings, it's not what you make, it's what you keep that matters. Folks, I appreciate your patience. We're on to our last topic right now, saving and investing and how to earn more. Again, you can get a copy of these slides and the recording of this event by sending me an email. I'll have my contact info up in just a few minutes. I bring this up because this slide has a lot of valuable resources that I recommend and personally use. Let's take a look at some of them. At the top, what are you earning on your bank account, your savings account? I've come across so many people who have a ton of money in a savings account that is earning nothing. You want to be earning at least 4%, and there's easy ways to do that with an online bank that you link to your current bank account. I'm with Capital One, for example, and they're currently paying 4.35% interest. So make sure you're earning at least 4%. Investment performance, we touched on, not going to say anything more about that. Financial literacy. So to get yourself up to speed, to learn more, I try to do these every month. You can attend my webinars. There's other advisors that have them as well. Websites I like, Bankrate, NerdWallet, Investopedia. Dave Ramsey's Financial Peace University. I started teaching the class at my church just last night. That's a great resource and website. Dave has a podcast too. Jill on Money. That's Jill Schlesinger. She does a nice job. Daily 15-minute podcasts where she's talking to folks just like you and I about our financial situation. She's very sharp. She asks excellent questions. That's what I like about her, and she helps me to do a better job with my clients. Investopedia Express. I listen to that every Monday morning. That's Caleb Silver. It's 30 minutes. He does a recap of what happened in the markets last week. He does a forecast of what's coming this week, what we can expect. And then he usually interviews somebody with some area of financial expertise. Investopedia. Okay, we're getting to the end. Thanks again for your patience. Asset allocation. That simply refers to how much you have invested in different asset classes. And that's something you all should know. How many of you know the current allocation in your TSP right now? That's not only which funds you own in the TSP, but where the current contribution's going. How much is Roth? How much is traditional? These are questions you must be able to answer. This is your diversification. It's how much risk you're taking. It determines how large your TSP might become and the tax consequences. What about rebalancing? How often do you do that? Some of you wonder what I'm talking about. If you're in an L fund or a target date fund, then it's done automatically for you. We touched on that in the first slide. If you're not in an L fund, let me explain. Early on, you set an allocation. Maybe that was 50-50, 50% stock market, 50% bond market. In the TSP, that might look something like 50% in the C fund, 50% in the F fund. Over time, markets move and that allocation changes. Rebalancing keeps you at 50-50. My firm rebalances quarterly. If you need help with this, let me know. It's important. Not doing it or neglecting it will lead to what we talked about earlier, over diversification or under diversification. This slide speaks for itself. It's my strong belief that every family needs a financial plan. Financial plan assesses and addresses your goals, and it gives you action steps to achieve those goals. Absent a plan, all you really have is a wish, a dream, whatever you want to call it. My firm, Turning Point, excels at planning. It's what we're known for. We call our plan Compass because it provides direction. Some people, they're able to create their own plan, and that works too. Regardless, make sure you have one or you have plans to get one done. Most people wait until they're approaching retirement, and every one of them, they say the same thing. I wish I'd have done this sooner. Getting a financial plan in your 30s, 40s, even 50s, it allows you to get set up correctly and fix anything that might need tweaked. I did my first plan in my early 50s, and I certainly wish I had done it sooner. Here's a look at what we discussed today, and we're going to get to questions in just a minute. Next, a list of action items, things for you to consider from our presentation today. We're back again next month. Our webinar is February the 14th at noon Eastern. The topic is 5 financial pitfalls to avoid this year. Here's my full contact information, our website. I'm on LinkedIn. I post content regularly. I have my own newsletter. It's free. I encourage you to sign up for it. Just send me an email. It's called Weekend Reads. First edition of 2024 is coming out this Friday. Lastly, I mentioned at the beginning of our presentation, your participation today, it entitles you to a free consultation with me. Send me an email if you're interested, and we'll schedule a time to meet virtually or by phone. Or if you want to come to the office in Frederick, that's okay too. Let's take a look at some questions. You can use the Q&A field or the chat. Alternatively, you can email me any questions. I want to thank everybody for being here today. If we can be of service to you, please reach out. Love to meet you and talk about your financial life and see how we might be able to add value. Appreciate your time today. Be safe, stay healthy. Thank you very much. Hope to see you next month.